Good afternoon, everyone, and thank you very much for joining us on this second webinar around the Chief Value Officer. In particular, today we're looking at how to drive value through ESG and sustainability. Apologies for a little bit of a late start, but we're just letting everyone get into the room. All right, so today's agenda, if we can go to the next slide, please. Oh, just sorry, some housekeeping first. You can submit questions in the questions tab. We'll try to answer as many questions as you can during the session, so please feel free to shoot through any questions. I'll ask them. If you've got any technical difficulties, either please click support or visit the website listed there. After this session, we will send a follow-up email containing some of the presentation slides, a link to our recorded session, and access to other webinars in the series, plus also our contact details here. All right, so today we're just going to go through some quick introductions with panelists, recap on the Chief Value Officer concept and what we did with the ACCA and BDO here, and then look through what the value is in the context of ESG and sustainability, what the opportunities in ESG and sustainability to add value, and how does finance play a role here. And then when we've got some time at the end, we'll have some questions and answers. But please let us know if you've got any questions, and we'll try and answer them during the session. So if we go to the next slide. So today, our panelists. So obviously, Nick Fox, I'm a partner here at BDO, leading the CFO advisory team. I'll be chairing it today. With me, I've got Max from Edge Impact, who's the head of client impact. Max, would you like to quickly introduce yourself?
Hello, everybody. My name is Max Van Biene. Yes, I am head of client impact at Edge Impact. We're a global sustainability advisory firm, or ESG advisory firm, with main presence in Australia and New Zealand. A little bit about me, background. I've been a sort of an ESG consultant for the last 15 years or so, primarily working previously with heads of sustainability or heads of ESG, working in developing their sustainability strategy. More recently, I've been very much working with board capacity building and finance teams on how to start integrating ESG and sustainability thinking into their work and the governance of organizations. So a lot more work on governance as well within organizations. It's a bit about me.
Yeah, thanks very much, Max. And we've also got Kevin, also from BDO, partner in IFRS and corporate reporting. Kevin, do you want to introduce yourself?
Thank you, Nick, and hello everybody, and hello Max. It's good to be here. Just an introduction from myself. A lot of you will probably know me already from other webinars that we do out of BDO. As Nick says, I'm IFRS and corporate reporting advisory partner. Where and why do I come into this? IFRS is, shall I call it, my traditional specialism over the last 20 years or so. We sit alongside both CFO advisory as well as strategy and transformation and sustainability more broadly at BDO, because it's shall we call it, a whole of service offering, because it affects more than just the reporting elements. Reporting is just one component of it, and because we deal with all complexities related to corporate reporting, sustainability reporting is falling into that, because it is, after all, a corporate reporting matter. In terms of my involvement in sustainability, as we've pointed out, we're helping with drafting of sustainability reports, as well as helping organizations prepare for mandatory disclosures, climate-related disclosures. And I'm also a member of BDO's National Sustainability Services Committee. Thanks, Nick.
Oh, thank you both, and really appreciate your time today. Just go to the next slide. We'll recap the Chief Value Officer concept. So around June this year, the ACCA and BDO got together, released a report based on the evolution of the CFO to becoming the Chief Value Officer in corporations. Now, what that report basically said in a nutshell is that there's a shift in CFOs from basically being the recorders of value to actually enhancing value within organizations. And there's an opportunity for CFOs and finance teams in particular to really add value to their organizations through the data analytics and through the opportunities that present themselves within the organizations. However, having said that, so the opportunity only presents itself through finance team members and CFOs who really take a broader view of what value actually is within the organization, and also start to touch on other areas of the organization. So in a lot of the roundtables that we had, discussion came up whereby we found that CFOs considered cross skill sets to be really, really important. And the opportunity is that as you're growing as a finance team member, or finance team members should be actually working in alternate groups within the organization. So sustainability is one of these areas where we're seeing a lot of value to be added, and therefore finance team members should be embedding themselves within sustainability teams if that opportunity is arising. And I think that's one of those areas that we need to be looking at. So we've got a quick poll that we want to start with now. First question up is basically around sustainability. Is it itemized on your organization's risk register? So we'll have a quick 30 seconds, see how we go, and get the answers for this. All right. I'll just give it another couple of seconds for that poll. And then straight after that, there's sort of a second question based on this, which is, do your board meetings have a standing agenda item to discuss sustainability related matters? So that's a really interesting result. So yes, it's on the risk register, it's 40%, but quite clearly followed after that, it's 38% unsure and don't have a risk register. That's been that's quite a good result.
It's an interesting result because it actually surprised me in some ways that the risk register was so high in that poll. Experience is showing that in some ways or form, it's not that developed in an organization's risk matrix or a risk formula. So one is, it's good to see that, but it's also interesting the number of people who answered that no and not sure, because that also means there's some way to go on this.
And I think the answers here will be quite similar as well. We'll give it another couple of seconds. And we'll get the results shortly. So it's not on the board. There you go. And then a final related question. Apologies for hammering three questions straight away. But if you answered yes to this question, which is that wasn't many people, who has been delegated with responsibility for sustainability matters? So we'll leave this open. So this is basically setting the scene for everyone here to understand where sustainability sits within your organization. Is it on the risk register? Is it on the board's radar? And then who is actually responsible? Now, with the idea of the chief value officer, we would actually like to see the CFO being responsible, but that's not always going to be the case. So we might just close that poll off as well. And
Nick, can you just leave that one up quickly? Yeah, there we go. That is fascinating, but not unexpected. Max, I'd be interested to know your argue on this particular one.
Yeah, I mean, it depends on the size of the organization, but usually ESG, very rarely yet does ESG fall under the CFO. It's usually coming under, I'm surprised to see that the CFO is actually being the COO there, because it does come under the Chief Operating Officer. Obviously, within larger organizations now, we're actually seeing Chief Sustainability Officers that are put in place. So, but you're right, there is no one universal. When we work with sort of heads of sustainability or heads of ESG, they're usually reporting to the COO when that particular position is in place. Sometimes the CEO, but yeah, it does vary across organizations.
Yeah.
Excellent.
Just
So
Nick,
that's
I'm
really
not
good.
sure if you want to go back to the previous one. I don't think you need to bring it up, but just to kind of remind everybody, I think the question that Nick flashed on the screen, in the sandwich question in the middle, was about whether this was on board agendas, and I'm almost sure my eye caught something like 61% said no. Is that correct from the poll?
Yeah, it was very high that it wasn't on the board agendas, and I think that's really important. I think as the mandatory reporting requirements come through, I think it's going to be much more on board agendas. I don't know if Max, you're considering that as well.
Well, it needs to be. If you're compliant with mandatory climate risk, you need to have demonstrated that you've integrated into your enterprise level risk screening, and that the board is understanding as part of their due diligence of material climate risks. And but climate's only one part, and I thought that's quite interesting when you mentioned, is ESG or sustainability currently on your risk register? Well, I think it really comes down to how you define ESG. So ESG is, if you ask what sustainability is, it's really those non-financial issues. It's everything that's in the non-financial bucket. So that can actually range from data breaches, data gaps, like we've been seeing in some organizations, all the way through to diversity and inclusion, social issues around supply chain, modern slavery, all the way through to your traditional things that most people think about, which is emissions, waste, resource consumption. So I think if we took that broader perspective on ESG, particularly around looking at the impact of supply chains, then I would probably be very surprised if there weren't elements related to ESG on a company's risk register. It just depends on how you define it.
Yeah, I agree with that, because in my mind, I always talk about access to people, markets, and capital, and in a way, any risk that feeds into those three is a sustainability issue at its core, because it ultimately comes down to sustainability of the organization and the sustainable future, both of the planet out there, but also of the organization itself.
Absolutely, that's great. So if we go to the next slide quickly, and first question that we've sort of got here is, what is value in the context of ESG and sustainability? And I think I'm going to throw to Max in the first instance here, because there's a huge amount of value, I'm sure. But I suppose from a finance perspective, we're looking at it, but also here, there's going to be massive amounts that you can talk into. So I think you've got some slides that you can share as well. So
yeah, all right. Well, awesome. I'll see if I can share those slides. But let's just have a quick look. So I think obviously, as a sustainability consultant or ESG consultant, a lot of my career has been spent trying to help build the business case for sustainability action. So we're a little bit, most sustainability consultants, this will be the first thing that they refine is, what value does this work actually add? And broadly speaking, when we think about the value add of ESG or best practice ESG or sustainability, we see it as two sides of the coin. One is your long-term financial resilience, so the financial element of it, and that obviously brings in the Chief Value Officer and the CFO right square in the center. And the other part is the stakeholder side of things and some of the softer elements in relation to sustainability. So I might just quickly run through some of these, and then Kevin, if you want to jump in at any particular time, feel free to do so. And I'll try and my best to put in the context of finance as well within an organization. So the very first thing, of course, is delivering cost savings. So when people, one of the areas where people think sustainability, they think resource consumption reduction, they think renewable energy, they think capital infrastructure upgrades and interventions there. In a time when energy costs are rising, obviously that is a immediate quick win. And in most organizations, that's pretty much been squeezed. That lever has been pulled already, just mostly because it makes strong and real financial sense. But there are other cost savings that in relation particularly to compliance. So that's like the cost savings in relation to infrastructure, particularly energy. But when we also think about compliance costs, particularly when we've got an avalanche of disclosures down the pipe, and I'll just quick context that, climate-related financial disclosures coming in, down the line, you've got a whole, it's the first of a tranche of many. nature-related financial disclosures, social inequality disclosures, increased modern slavery compliance. So in the ESG space, we're just in a wave of it getting more and more and more, and it's not going away. So getting ahead of the curve and putting the foundations in here will help you save costs and time for compliance later on, as well as all the traditional savings that you can have there. The second one, I think that's the most important thing here is reducing portfolio vulnerability. So that's ultimately what the climate-related financial disclosures are meant to be, but also broader ESG is you understanding essentially your non-financial risks and opportunities in a way that helps you mitigate their impact. So that might be, for example, obviously COVID is a good example of an impact of organizations. Have we identified elements that are outside of our control? Climate change, social impacts, other elements that might not be in our control. For example, changing legislation around waste packaging, for example, that might increase the financial vulnerability of the organization. The purpose, and I'm going to refer back to this in a few times here, but mandatory climate disclosure is a good example of saying, hey, do you understand the material risks and opportunities to do with climate change? And they could be anything from the physical impact on your assets, heat waves, floods, all the way through to transitionary risks, so movement to renewable energy, changes in supply chain structure, changes in consumer demand. Do you know the impact of that on your financial bottom line? So it demonstrates that if you're across ESG, you understand how these things are going to impact your business, and therefore you have reduced your vulnerability to those externalities. And then, of course, the benefit of doing that is the third element, which is addressing investor requirements. Investors want to know that you've reduced that you've addressed those risks and opportunities. And so that's probably the access to capital. All of those benefits come through that. And then finally, the promotion of innovation and collaboration. And when we talk about that, that's another fancy word for essentially product design. How can you design your products and services in a way that is that ticks the ESG box, but also delivers a great product. So it's a great way to stimulate and integrate with your design team and your finance team and your executive to be able to create products and services that are meaningful for your end customers, but also deliver good outcomes. So that's the financial resilience piece. Kevin, I don't know if you wanted to jump in on any of those elements in particular before I jump on before we discuss the other side.
Yeah, look, I mean, I couldn't have articulated it better. So there were two things you said which resonated with me, which forms the core of everything we're seeing as well, which is really, do you understand the non-financial risks and opportunities? And this will come later on to the CFO as a Chief Value Officer, is moving from that finance side to the non-financial risk and opportunities. But in the first instance, ESG adds value to the business as a whole by understanding the non-financial measures, driving those through. So that was the first thing that resonated. The second thing then is, do you understand the material risk and opportunities that they have on your bottom line? Why I'm referring to those is that is how the mandatory climate-related disclosures are essentially organized. They are organized to essentially flesh out, do you understand the risks and opportunities? How have you translated that into your strategy? How does that impact your bottom line? And which is really under investor requirements. Investor requirements aren't all about mandatory disclosure. It is just one thing that's coming. It will be mandatory at some point, whereas at the moment it's voluntary. But really, that's the core of what it's trying to achieve, is that communication out to the broader investor group, but also to your people and your supply chains, how this all translates from risk and opportunities down to financial bottom line, and then communicating that. I would like to just make the point that one of the things that's starting to happen is the mandatory climate-related disclosures that is coming down the pike is really focused on climate, but that's just the first of a number of issues. So as Max had mentioned earlier, it's not all about climate, it's really about any risk and opportunities that's non-financial. And the standard setters that are driving mandatory disclosures, they will have later on they will have standards on biodiversity, workplace, human capital. They're all coming. This is just the starting point. So let's not get fixated on climate. That is the first mandatory, but the reality is it's all non-financial risks and how those drive through to opportunities and ultimately the bottom line.
That's actually quite good in terms of, there's actually a question that's popped up in terms of, whilst there's broad focus on ESG, as the government regulation is pointing more to climate related matters through draft standard now issued, will there be more focus for broader businesses, and how much will people focus on broader aspects of ESG rather than just climate change? So I think you guys have already sort of answered that in terms of where the direction's going. It's the from what I've heard and what you guys have talked about is effectively the mandatory reporting requirements in Australia in particular are focused on climate right now. But my understanding, and correct me if I'm wrong here, is that if we look broader afield and look at Europe, for instance, they're already going down a whole load of different ESG reporting standards.
Well, I mean, Australia there's already 16 jurisdictions around the world that's got climate-related financial disclosures in place. New Zealand obviously implemented that, well, I think it was January this year, and so they're a little bit ahead of us in Australia. But I think what it's demonstrated and what's followed in is they've used climate as a way of setting up the template, so to speak, so TCFD, setting up the template for the way in which an organization addresses non-financial risks and opportunities, and more importantly, quantifies those non-financial risks and opportunities into financial impact, or has done that sort of modeling. So if we look at what's coming down, I mentioned before, TNFD, so nature's on its way. The modern slavery compliance is going to broaden out. So we had modern slavery introduced in 2018 Act that's going to broaden out based on the Attorney General's view, which is going to go down a similar path in that organizations are not only just going to be able to go, oh yeah, we've looked at our supply chain for modern slavery, it's all good. It's if you've identified actual risk, you have to demonstrate you're doing something about it. So it's moving from transparency to active due diligence and active mitigation, I should say. And then after that, and after then we're going to, as of January as well, in terms of disclosure, we're seeing pay gap, gender pay gap and equality data being published publicly. So we're seeing increased amount of data and disclosure occurring. And so these issues, especially if they're rising issues within an organization, are going to suddenly be thrown onto the board and your overarching management to try and address them. So yeah, so what I was saying is climate setting the template for you to manage these other ones as they come through.
Yeah, I agree with that. I mean, it is a template, and if you start to set your organization up around risks and opportunities which are non-financial, including climate, the rest will follow, if not drop out along the way. But there are clearly some mandatory requirements first and foremost, which is climate. And as Max said, there's a whole bunch of other legislation about gender, that requires certain disclosures up front, but that is the template that they're driving at. The template that they're setting up is also to establish the link through to the bottom line, but also to remuneration and how boards and management are remunerated on these variables. Climate being the first, but the rest will follow as well.
So I might touch on the other side of the coin, because obviously we've touched on the financial resilience, and that is really the kind of particularly the portfolio vulnerability, the key value proposition. There are obviously ESG has other value creators as well. Primarily being, one of the main drivers is employee and team retention. If you're seen as being doing good things within organizations strong in ESG, it's been proven that you can attract and retain employees. Obviously community engagement, brand awareness, and purpose-driven values. So these are things that are actually usually the strong focus of a sustainability, but also of the sustainability manager, but also, obviously HR functions as well. But it demonstrates how ESG can be a cross-functional kind of stream across various different business units within an organization, if in terms of adding value.
And that's really good in terms of the chief value officer prospect or hypotheses here is effectively, we've talked about how at the roundtables, working with different business units is how we're actually going to add value as finance professionals. And in this instance, it's understanding the sustainability elements and the ESG elements will actually help you to add value within those business units as well, if those opportunities do arise.
Yeah,
All right.
I think.
Yeah. Oh, sorry, go ahead.
No, over to you, mate. Yes.
And I think that actually leads into the next poll question as well, which is around the opportunity and where do we see opportunities arising through ESG and sustainability. So where do you see in relation to sustainability, and I think we should use the word sort of interchangeably here, ESG and sustainability, what do you see as the key opportunities or the key opportunities for your organization? And we've got there a couple of ideas in terms of the staff attraction and retention, good corporate citizenship, winning more work, so access to markets, better access to capital, or none of the above. So this is what we've been seeing in the market, a lot of people talking about in terms of the opportunities that do present themselves. But if you don't agree, feel free to do so. So we'll leave that up. All right, let's just see those results now. So predominantly in the good corporate citizenship. So that's the opportunity there, but winning more work and also attractive staff attraction and retention, I think is the next one. Yep. So I think that's really good. And interestingly enough, no nones.
I think it'd be a brave person on the webinar today to tick none, and I was actually waiting to see if somebody would be brave enough to tick none. I mean, I think the value is demonstrated. Going back to the polls there, I mean, I think the answers demonstrate that to some degree we see the value of perhaps more work or some value, but it doesn't seem to translate much to board and strategy just yet. So some of those things like access to capital, at some point you will find that the cost of capital will either be contingent on this or it'll be cheaper if it is tied to this, and that will hit a board or a risk committee really hard, really quickly. Max can probably kind of tie into that, but we're seeing that really happening quickly. And in a high interest rate environment, entities are looking for cheaper debt, and they're finding it in capital or loans from banks that are linked to ESG or sustainability measures. So that became clear to me. Is some value is clear in terms of growing the business, but don't underestimate the link to borrowing and financing and the cost of equity, let's say.
Yeah, I mean, it's probably worth reflecting. Just an anecdote, in my career, being in sustainability for as long as I have, it used to be that we would have to spend a lot of our time building the business case to be proactive in this space. Yeah. The first 10 or 12 10 or 12 hours of meetings would be in just trying to help build the business case. Now that's done for us, which is great, because it just fast forwards it all. People understand the value, whether it be voluntary action or compliance, which is more and more coming down the pipeline. I think the thing, just going back though to the comment and the question that was before, which was really around what is going to be the impact of these increased compliance requirements, and how can we go, because there's two paths that it could go in the context of value, right? There's one path where you just scramble to report and you comply. And that means you get out your disclosure as quickly as you can, and you spend, 80% of your time just trying to comply to that particular, in the context of climate risk, get out the things similar to the way that a lot of organizations, for better or for worse, complied to the Modern Slavery Act. Okay, we've got to go through these things, and we just got to get the statement out. Now, I think we've learned from the Modern Slavery Act that if you just tick the box and it's just a tick boxing exercise, it doesn't actually have the intended value that it's meant to have in embedding in your organization. So in the context of modern slavery, there were kind of two paths that organizations went down. They said, oh yes, we did a very high level screening of our supply chain, and we identified these risks, but they weren't a big deal, and did a nice statement and got it out there. But there were other organizations that actually did use as an opportunity to meaningfully engage their supply chain, actually speak to their high risk suppliers, who happen to also be often the ones that were high in terms of emissions as well, and start setting up the foundations for engagement and reporting. And now we're seeing all this scope 3 emission stuff and what's the emissions of your supply chain. Those organizations are ahead, right? They're the ones that have done the hard yards and did it properly first, and now are shortcutting a lot of these elements around emissions reporting and around scope 3. So in other words, what I'm trying to say is you can either spin your wheels to report for reporting's sake, or you can actually really dive into these issues, particularly from a finance perspective, dive into the risk and opportunities and use it as a way to add value across a variety of things, which, you know, I can talk to now if you'd like. I mean, broadly speaking, I'm not sure if my slides are shared, but there's a whole bunch of things that through this process can actually add value rather than just simply reporting for reporting's sake. And I think it's important that we recognize that.
We can see your slides.
We can see your slide.
Oh, you can? All right, great.
And,
awesome.
And look, just as you're bringing that up, I think there's someone's made a comment, and I was thinking about this as well. Is it interesting? You even get small interest rate discount from some banks if your house has a higher energy certification. And I know that my bank, if I get a 7-star rating on my house, will actually provide, I think it's a 0.5% decrease on my mortgage rate, so on my interest rate. So even as a personal borrower, you can see those impacts coming through.
Yep. And Kevin, I don't know if you want to speak to anything about green loans or, you know, all the stuff that's happening there at a corporate space.
Yeah, look, I think I've made the point, and it's not only that you can access it, but it's actually a lot of the banks. I'm not trying to advertise the big banks for anyone to go to, but they'll actually work with you to identify your metrics, which actually will help you drive this change through your organization. Look, it doesn't necessarily have to be dictated by them. There are some banks and financiers will actually work with you to establish your materiality assessment, understand what metrics can be measured and what's your driver for change, and actually organize financing around that. So I agree with Max. It's almost selling itself in a way now. It doesn't seem to be needed to be justified. And also on the comments that Max made about sort of implementing thing about box ticking, coming from the IFRS side, you know, IFRS has been around now for 15 years, maybe longer in Australia, and most people see IFRS and corporate reporting as a compliance exercise. At the end of the year, you suddenly spin your wheels, you suddenly put some Excel spreadsheets together and you report the numbers in your financials. That's not going to work in this environment. You can do that if you want to, but it will be obvious to the investors and the readers immediately that you are generalizing or even greenwashing or green hushing along the way, because you won't actually be able to make the disclosures if that is your approach. It will become very obvious very quickly, because you can't fluff engaging with your supply chain or your value chain on the last minute. It's something that has to become embedded, ingrained over time. So I think, Max, you're going to talk to that now.
Yeah, I think it's not something that you can tick even over 1 year. And I think the challenge that's happening is organizations in that tier 1 cohort are realizing the amount of work that needs to be done to comply with it. I thought I would just quickly share with you, but you know, and we don't want this whole conversation to be overtaken by mandatory climate-related financial disclosures, although it's probably on the radar of most CFOs now. But the reason why it is worth bringing up in the context of value is it is a really good opportunity to use ESG, to integrate ESG into the organization strategy and operations, because it is a way of what this is forcing organizations to do is essentially, as I said, integrate these risks and opportunities into your financial modeling of an organization. So if you look at how that's done over a 3-year period, this is a bit of a detailed slide, but it does show you what the amount of work that's required across a 3-year period. And ultimately, what we're looking for is the first year you understand your risks and opportunities. The second year you integrate, or phase 2, you integrate those risks and opportunities into your governance structure. And the third year you translate those risks and opportunities into into what the financial impact is. So essentially impact on income, cash flow and balance sheet. And so there's a lot of work that needs to be done here, including the collection of data and doing this bottom-up, essentially physical risk assessment and transitional risk assessment for organizations. So these are areas that traditionally were managed by sustainability teams, but now from a value point of view, better or worse, plus or minus, they need to be incorporated with the finance team, because the finance team needs to understand, for example, what is the impact of a changing climate, increased heat waves, increased flood zones, on the ability for our assets to continue to operate, or do we have any stranded assets that are going to be stranded? Have we invested in buildings, for example, that are just not simply fit for a 40+ degree day? Or do we have assets that just aren't ready for a climate changed world? And how do I get rid of those stranded assets, essentially start offloading them to mitigate my risk? Or transition risk similarly. So this is the data that needs to be happening. And then that's positive and negative. If you can tell a positive story about this, demonstrate to investors that you have designed products and services that are immune to, or have low risk in a climate change world, or that you've effectively mitigated these, you've identified and mitigated these risks, then of course you will actually have benefits. And there are a bunch of benefits that can be done across all of these elements, from understanding your at-risk operations, efficiencies and costs we just talked about, where your hotspots are across your emissions profile, all the way through to board and leadership capacity building. I think the biggest one that is going to be super interesting to see will be scenario modeling, scenario planning. Obviously, it's an area where the finance team have been working on a lot, but climate scenarios are a whole different ballgame, much longer time frames, and much increased amounts of uncertainty. So how do you start integrating that into your financial modeling? That is going to be an interesting process. And then, of course, obviously the financial resilience, product design, and supply chain engagement as well. So they're just some benefits that, as some value that can be created through this process if done properly. And again, climate being just one example of ESG elements. Again, you can imagine that if you take this lens over modern slavery or nature, there will be a whole bunch of other benefits that get started integrated into your business if done properly.
Okay, and I'll kind of add on to that, and maybe Nick, this is where you want to go next, but that sort of timeline that Max put on there is what we're seeing in practice, and we're also using something similar depending on where our clients are starting. So Max, I support what you put on there. I think the opportunity for the CFO and the CVO is to put yourself at the center of this. If you kind of drill this down, interestingly is the finance team and the CFO have the experience in terms of data and system and bringing all the pieces together in an organization already when it comes to finance. So why can't that be transferable to the non-financial side as well, and actually support data, technology, and so forth to build this up? Because the organization is going to need to understand its metrics or its numbers or its scope 1 and 2 and 3 in order to start to build this into their risk strategy and into the risk opportunity and to their strategies. And as Max said, there's a scenario analysis that's waiting for you at the end of this screen. Somebody's going to have to build that, and somebody's going to have to, support the processes and the systems around it. And in my mind, surely that's the value officer, aka CFO, and the finance team who would be supporting that. And even if it doesn't centrally belong there down the track, they're going to play a huge part in that to begin with, and also at the end. So the opportunity for the CFO and as the chief value officer, it seems to be clear: data, systems, dashboards, support the strategy, support the organization. And when it all pops out at the end, it's going to have to be part of your annual report down the track anyhow. And guess who authors that? The CFO and the finance team. So it's going to kind of fall to the CFO at some point to actually articulate this and put it all in language.
Max said it's, for better or worse, it'll be with the finance team. Being an accountant and CFO advisory, I like to think it's for the better. But we might quickly go to the next poll question, which is more around the opportunity that you yourselves see. So
I feel like I just jumped the gun there, didn't I?
Yeah, it's almost like we planned it. So I think this is more about you personally as a finance team member, as a finance leader. What are those opportunities that actually come in? And just as we're getting some of those answers, I wanted to reflect on some of the comments that we've been talking about here, and how we're seeing in the last poll question as well, one of the biggest areas was not only being a good corporate citizen, but it was actually staff attraction and retention. Now, from a finance perspective, if financial people, the finance team and the FP&A team, for instance, are actually doing this reporting, they're going to see whether you're greenwashing or not. So if you are going down those paths, you're actually better off, doing proper reporting of proper actual ESG and sustainability programs, because your team members who are actually going through this process are actually going to see it. So there we are. That's really interesting. There's not many people who think, well, no people think there are other opportunities or no opportunities, but the reporting responsibilities are there, taking ownership of non-financial sustainability data, and increased access to decision makers coming in third. So I think that's really important, taking ownership of that non-financial data. And we're seeing that more and more in finance teams, where they are actually taking responsibility for non-financial data. So if we pop up the slides that we had before with just a couple of other key components that we're looking at, but I think that's really telling in terms of where we see the opportunity as finance people. So we've talked about the opportunities in ESG and sustainability to add value. And now I suppose sort of looping it all together, and I've touched upon this, but how does finance play a part? And I think, Max, you, Kevin, and I had a conversation recently whereby we started talking about how you've been in this game for 15 years, but really recently there's been the people who are showing up in your meetings who are the finance teams who are saying, what does this all mean? How do we report on it? And I suppose, how do they actually play a part? I suppose in certain respects you could say they're late to the game, but better now than ever. And this is where the opportunity lies.
Well, welcome to the party is a better way to welcome to the party.
That's much better.
Probably. No, I think this has been, if you speak to any sustainability person or ESG person, they are giddy with excitement that finally the CFOs are knocking on their door, because this is obviously, if you've been in sustainability teams for years, been wanting to get access to the CFO for ages, and it's just not been on the cards. Or it has been in some organizations, but not in the extent that it's really happening now. So I think we discussed the first major part, which is, finance is going to start playing a role in terms of reporting, but in terms of understanding those physical risks and opportunities. But I think the main role that I'd encourage finance teams to look into is, like, beyond the disclosure part, what is your corporate ESG reporting going to look like moving forward? We discussed, and this is beyond just climate. So have a think about broader reporting frameworks and understand what those broader reporting frameworks are. As I said, there is a big risk of this climate play totally derailing progress in other areas of ESG. So, and it shouldn't. So we'd encourage anyone in the finance team to get across the GRI, Global Reporting Initiative, and what that means, because that is like still the standard that is about holistic ESG reporting. That's across the full spectrum of ESG issues. Understanding what those are and understanding what what's going to be going out in a sustainability report, and how that's going to integrate with your broader annual statement. I think, the other thing that you should know about, and I think it's probably worthwhile kind of re-emphasizing again, is that obviously traditionally when we think about corporate performance, it was your financial reports come out usually in your annual report, and then your sustainability or ESG report would often come out at a different time. And the main bit of feedback was, hey, we can't compare the two. Why is ESG and sustainability report coming out at a different time? That's all fine, but investors are going, shouldn't they be together so we can compare and contrast them and understand? So in addition, the major requirement is that these things get reported at the same time. So they're going to be coming out as a package, and they're going to have to talk to each other. So really it's about starting up a dialogue around, okay, what are we doing internally strategically? to address our risks and opportunities, and I would emphasize opportunities in that space as well, because there is, and we know from a business growth point of view, that sustainability products and services, or products and services that might address that part of the market, are doing pretty well. So that's, we emphasize that, but also how are we going to tell our financial story alongside our non-financial story? That's just a quick summary of some of the elements. I don't know, Kevin, if you want to add to that.
Yeah, I mean, you have this knack of summarizing it so succinctly. I think just to talk to CFOs and finance teams, and in their role as a CVO, are going to be at the center of this process. You've got the competencies, you're organizing yourselves around commercial acumen, technology and data and so forth. And ultimately it's going to form part of the CFO remit, because that story is going to integrate into your annual report. That is where we're heading, and that's going to drive down to the numbers, and ultimately is going to drive down to remuneration and so forth, which to a large degree is measured right now through the finance teams and reported up to the boards. So that isn't going to change. It's just going to increase and become complementary. I'll just actually put a little anecdote on the table. I've said this at a few other panels and sessions that I've been to. Coming from an IFRS background, I would say that in the last 6 months, I've spoken to more boards and CFOs about sustainability than I have to the same people about IFRS in the last 3 years. It's so topical right now, and they all want to talk about it, but it's shown me that the CFOs have joined the party. So it's actually, just to come back to Max's point, is I can see that anecdotally in how I engage with my clients, because they suddenly want to talk to me because it's suddenly relevant to the CFOs and the people we deal with from a corporate reporting. So we've joined the party, Max. Lovely to see you. And we can see that in the market. I do think, however, that some of the CFOs are approaching it the wrong way. They're coming at it because suddenly it's going to be mandatory, as they're focusing very clearly on climate, and they're focusing on it as a compliance exercise. And I think it would be a mistake to take that approach. It's none of those things. It's value driven at the center of organization strategy, and it should be approached that way.
That's actually really interesting, and an anecdote that comes to mind for me, and it's a little bit, I suppose it could be a little bit off topic, but it is, I think, still within the topic. But I did a lot of work on the payment times reporting scheme in a previous life, and what we found was that scheme does actually have a good corporate citizenship piece to it, which is effectively how fast do you pay your small business suppliers. Now, that also actually ties into modern slavery, etc., because if you're delaying payment to your small business suppliers, they're more likely to be engaging in modern slavery issues. So there was a tie back there. But what we found was the discussions with CFOs and boards who actually said, we need to pay our small business suppliers faster. But the only way to do that was to actually go into their procure to pay processes and make it more efficient. But then by making it more efficient, all of a sudden they found that they were having working capital uplifts, because they actually had much better control over how they are paying all of their suppliers, not just their small business suppliers. So all of a sudden, through something that started off as a good corporate citizen piece, they've now wound up with better working capital management, and effectively have actually added value to their businesses quite by accident, in effect. But what have they also done? They've supported their small business suppliers. Those small business suppliers have grown and actually have started really engaging better with them. And so there's been some really good uplifts there. Now, we've got a good question that's come through, which is, whilst these disclosure requirements are starting with players at the higher end, and I think, Kevin, you and I have spoken about this, and I think, Max, we may have touched upon it, there will be pressure for all other businesses. There are so many small and medium-sized businesses out there which provide goods and services to the bigger end of town, and the ESG matters can either be taken as a compliance burden and potential risk to becoming an opportunity to differentiate their business. Challenge will be how to transition, as they would have limited resources. So I think we've talked about this previously, or I've touched upon it, I think, with both of you in this respect, is that whilst the mandatory requirements are coming out and saying bigger end of town, you're going to have to report immediately. Those bigger end of town players are actually going to start pushing their suppliers to start reporting as well. So even if it's not mandatory, it's going to become a differentiator, as is made with this statement of question. Now, it's how do you actually do this with limited resources? So I might try Max.
I mean, sustainability doesn't need to, I mean, obviously it really depends on your organization. And it's very hard to answer that as a broad brush, in a broad brush piece. I mean, the first thing to say is absolutely that's going to happen. So obviously climate risk is one area. And if we think of the most obvious area around that, then we think about scope 3 emissions targets, right? So for example, we work with a lot of large retailers who have suppliers all over, you know, if you look at the big supermarkets or large FMCG organizations, or retailers, I should say, they've got loads of suppliers. A lot of them have set scope 3 emissions reduction targets and set science-based targets. So they've publicly committed to reducing the emissions of their supply chain. And the only way they can do that is by using suppliers that have lower emissions. And so they are going to start choosing and favoring suppliers that either have emissions reduction targets or a demonstrated emissions reduction trajectory. So there's immediate opportunity there, and we know, especially from the big supermarkets, that they're already starting that process of filtering out and weighting their procurement process to organizations that have lower emissions. So I think reducing or demonstrating that the easiest way you can do that in resources is demonstrating that you have got a reduced emissions trajectory. If you're, depending on what organization you are, there's different ways to do that. Easiest way is obviously reduce your scope 2 emissions by going to renewable energy, but it really depends on where you're going, and that's a whole nother thing. But it doesn't require, what I'm trying to say is it doesn't require a whole amount of resources to do that. The other option is that you can use and get sort of different certifications that demonstrate that you are on that path. But yeah, scope 3 is a classic example of where it's going to start filtering down. How to do it in a way that doesn't take resources. I'd like to think that while some of those strategic and operational initiatives take time and money, that they do pay for themselves even operationally, so straight off the bat without even getting into it. So if you look at a lot of the packaging discussions, for example, they have benefits that are beyond even just to customers. So just some ideas there, but yeah, obviously resources are always a challenge.
I think comment I'll make is, I think that's the purpose of today's webinar, is the CFO as the CVO is the one that can prioritize the people, the resources in the organization to be nimble and flexible to react to where you need to focus your attention. So that's really the point of this, is the CFO needs to be part to that. I mean, all decisions in business revolve around organizing your resources and your limited resources to maximize the benefits to your organization long term. So it's prioritizing and identify where to focus. I mean, one of the ways to do this, especially in the CVO's role, Chief Value Officer's role, is to essentially understand where you fit in your larger supplier chains and start to engage with those organizations to understand what's about to be important. You don't want to focus your attention on something that's not going to be important down the path. That's just going to be madness. So getting ahead of the curve now and understanding it by engaging with those various stakeholders is the very basis of a materiality assessment. That's what you're trying to achieve. Max is right. I think scope 3 emissions is going to be important under any scenario. So it's probably getting an understanding about what that is and what that looks like. But at the end of the day, if you fit in a value chain somewhere and you're important to a customer or a supplier, either way, probably to somebody, to one of your customers, engage early to understand what's important to them, so you can focus your resources and your attention on that without wasting effort and cost.
That's really that's a good answer, and I think I'm just aware of time, and we're about to finish up, but there's actually a really good question that's popped through. It's quite a challenging one, actually. So if the CEO of an ASX listed company goes on an investor roadshow and the topic of sustainability has not been brought up once by the investors, how can sustainability professionals justify the ROI for sustainability initiatives and move sustainability up on the executive's agenda? And I think, paraphrasing here, what you've just talked about is the ROI actually sometimes speaks for itself. Now, probably, that's not going to be 100% of the time, but in a lot of cases, there's probably an ROI there, regardless of whether investors are asking for it or not. I'd like to open the floor though to that.
Hey Kevin, do you want to take that one?
I'm just going to say that, yeah, sure. I was going to say, Max, you should take it, but you've taken all of the other questions first. So I want to say if the investor isn't asking today, he's damn right going to ask tomorrow.
Yeah, that's right.
That's what's going to happen. It's coming, and we call them activist investors, or we just call them activists. Active investors is one word to say, investor that's keen and interested. But all investors are activist investors at some point or another, because ultimately the value of the investor is driven by these factors. They're going to ask the question, it's coming, and rather you would bring it up first than them. That's it.
That's right. You're given a reprieve. If you know that it's coming, use it as an opportunity to go, hey, look, if you look at the large institutional investors, we know they're moving. You look at this big super funds, they've definitely got it in almost all of their requirements. It's only going to flow in one direction. Yes, maybe some, the mum and pop investors maybe not asking those questions yet, but it's definitely going to come down the line. So you better. It would be advised to get ahead of it rather than being caught on the back foot.
Yeah. Look, I know we're at time, but another good question's come through. So I'll just be really quick on this one. If a company has already embarked on a solar program and therefore has already reduced its emissions, will it be penalised as it will not be able to reduce emissions as much in the future? And maybe I'll touch upon that one. It's an interesting one. I don't necessarily think it's about reduction. You don't have to show reduction, because eventually if you got to net zero yourself as a business, and correct me if I'm wrong here, you're already doing really well. So it's more about your reporting. It's not about the reduction. Correct me if I'm wrong there.
Well, I mean, one thing that you might want to consider doing is setting or getting approval of a science-based target. So one of the things that organizations are doing really, or getting up there, which is basically saying, hey, we're doing our part in reducing our emissions to 1.5 degree warming world. And by the way, we've already gone 85% of the way there. So it's demonstrating that you're on that trajectory, and it's a certification to say, hey, look, we've already done most of the hard work. So you don't have to demonstrate that you're reducing each year, but you have to demonstrate that you're doing your part in a 1.5 degree warming world. And that's the reason why your emissions, that's why you're celebrating your low emissions.
I'll go a step further and actually just say some of the organizations we work with who have offset strategies, it turns out that the quality of the offset and the alignment to strategic goals wasn't there once they got into this. Sometimes, I'm not saying it's not important, everyone's playing their part, but it's just also to understand how that fits into the broader strategy. I'll leave it at that with at 101.
All right, well, thank you. We're at time, so thank you everyone for attending. I'd really like to thank Max for joining us, and also Kevin as usual. Really do appreciate it. Look out for more in this series on the Chief Value Officer. But for now, thank you very much, and have a great day.
Thanks everyone. Thanks Max.
Thanks a lot.
Thanks Nick.
Thanks guys.